So we're going to continue this conversation now and bring in Wharton School Professor of Finance, Jeremy Siegel. Jeremy, great to see you.
Happy to see you. I'm older than both of you, and I always wear a necktie. So I guess it's the old generation. I don't know.
You're older and wiser, and that's why we're looking forward to hearing your perspectives on all this. I mean, bottom line on this PCE data, are we definitely going to see a rate cut, and is it almost certainly going to be 25 basis points?
Well, I think whether it's 25 or more, really, as you mentioned, depends on what we see next Friday. And there's even, some more reports coming before that September 18th. So, it's definitely going to be a cut. I think it's open between 25 and 50. I think it was really interesting, Wilfred, you mentioning about what's going on in the Eurozone's lower. They have a different method of computing the housing. And I've been on the Fed for so long saying their housing measure is lagged so much that it keeps on feeding in, even though, we have rental prices that have stabilized. They don't have that problem in Europe, and that's one reason I think it's further down. When I actually put, on the ground housing prices in, I actually get 2% or even below on year-over-year inflation. I think the Fed is there. And, I think, to stay at 5.33, well, they are going to go down. But, my feeling is they should move much faster towards what they say is the neutral rate. Now, in that June meeting, they say it was 2.8%. We're going to get a new read, new dot plot in 2.5 weeks. It may go up to 3, but that's still, over 200 basis points lower than where it is today.
Are you saying that, Professor Siegel, because you think, in fact, the inflation numbers give it the room to do so, so they may as well do so? Or is it because the economy is also weakening at a faster pace than they're perhaps appreciating?
Well, I am worried. I mean, certainly, I got worried with the last report, and it looked like those claims were heading way up. I get worried when they go above 240. Now they've stabilized down on 230. We shouldn't get too excited. We saw that 3% print, but that was April, May, June. We're, just on the verge of September. I was a little disturbed, for instance, the trade report yesterday didn't get a lot of, press because it was, overtaken by everything else. But the Fed, the Atlanta Fed, and several others are going to come out with a report later today. Believe it or not, I think this quarter might have a one handle on GDP. So, yeah, now that's not recession, and I'm not saying recession, but it is a slowdown. I think that, given that slowdown, given that the unemployment rate rose to 4.3%, that is above the Fed's long-term target, given we're within 0.5% on their own measure of their inflation target. My feeling is they should be closer to what they say is the neutral rate rather than tiptoe down, quarter point here and there. We'll get there eventually. Why take that risk? Be bolder. They were 75 basis points on the way up. For sure, They were way too late. And I'm not saying they should panic, but, lower, I think, is the better.
Although,
option.
Jeremy, I mean, you got a lot of attention not that long ago when you were on our air talking for an emergency rate cut, right?
Yeah,
Everybody was like, oh, my God, what? And you do seem to have backed off a bit from that. What was it you were seeing then that you maybe aren't seeing now?
Well, what I did see was that labor market and as I said, the claims report going considerably up. And I said, uh-oh. I saw the Psalms rule being triggered. I saw a number of other rules being triggered. And then I said to myself, well, why is the Fed at 5.3 when they say, it should be at 2.8 when it's long term? Now, I will absolutely admit, things calm down, the economy looks good. But, let's put it fine. Even if the GDP is at 2%, which is, let's say the long-term target, that doesn't argue to stay at 5.3 when you're that close to target. Some people are saying, oh, the economy's fine, leave it where it is. That's not the logic of the Fed. That's not what they say, unless they really think the Fed funds rate should be, 4.5 to 5, so they can tiptoe down. I don't hear that from anyone. So my feeling is I'm not quite sure why being so close, 80 to 100% there on unemployment, over 100% there, they are tiptoeing down so slowly on Fed funds.
So, Professor, tell us what this all does for your view on the S&P 500. If we've got 100 basis points priced in by the end of the year, we're probably not going to get more than that. With that in mind, do we also have to see the economy land softly? If it worsens, will rate cuts do enough to prop up the S&P 500, or do you kind of need a bit of both with where we are at the moment?
Well, as you know, the long bond is saying the Fed is going to be more aggressive than a lot of people think, and probably even than the dot plot. I mean, if you look forward to the June of next year, you see quite a number of cuts. So in some ways, the bond market is kind of doing the Fed's job for them, bringing down that mortgage rate, which is due to the 10-year. However, we should remember that a lot of small firms, as well as individuals, they don't finance at the 10-year if you're not buying a house. They finance at the prime rate, at what used to be called the LIBOR rate. Now it's called the SOFR rate. Firms finance at that short-term rate. That's one reason why small firms have been hurt so much more than the large firms by the rise of interest rates, is because they are much more short-term oriented. That lowering of rate, I think, would really help those smaller firms and would help the dividend-paying firms. I think a lowering of rates aggressively is really needed to turn that scenario around.
Yeah. So does that mean you want to stay away from sort of the mega cap part of the market, so to speak, and kind of lean into this broadening theme we talk so often about?
Well, I mean, I certainly think there's a reason for that, and I like those relative valuations. I just don't want the Fed to go down too slow. So if the data looks weak and they only go down 25 basis points, then I get more worried. Again, slow down to maybe 0 to 1% for 2 or 3 quarters. I mean, we've got to be negative for a recession. Actually, even more, a little bit than that. We had 2 quarters actually a couple of years ago. We had negative. We didn't call it because the unemployment rate didn't go up. But now we have that unemployment rate. I'm not calling a recession. I'm just saying the Fed, if it goes down too slow, is taking a risk that I don't think it has to take.